All right, let's talk about the one institution that pretty much everyone in global finance is watching right now, the U.S. Federal Reserve. See, they just made a move, a really big one that sent some serious shockwaves through the markets. It was a huge and kind of surprising pivot in their policy. So, what exactly did they do? And more importantly, why should you care? Let's break it all down. When the Fed changes direction, it's not just a Wall Street thing. Oh no. The effects, they create these ripples that are felt in economies all over the world. So, that leads us to the big questions, right? Why the sudden change of course? And what does this pivot really mean for all of us?
So, first up, the Fed's new direction. Let's get into what they actually announced. Now, this wasn't some minor tweak or a small adjustment. This was a clear, unmistakable signal of a major shift in their strategy for managing the world's largest economy.
It all boils down to two crucial moves. First, they cut their main interest rate by 25 basis points. That's a quarter of a percentage point. And second, and this is the one that really got everyone talking, they announced they're stopping the reduction of their massive balance sheet. That's a big deal. So what do these two actions actually mean for the economy?
To really understand the impact here, we need to look at the Fed's two main weapons, interest and the balance sheet. Think of the interest rate as the gas pedal for the economy. The other one, the balance sheet, well, that's a bit more complex. So let's dive into how that works.
So when the economy needs a boost, like it did during the pandemic, the Fed uses a tool called quantitative easing. Just call it QE. Think of it as a massive injection of cash. They go out and buy up financial assets like bonds, and that pumps trillions of dollars right into the financial system to get things moving again.
But what happens when all that easy money leads to high inflation? Well, the Fed does the exact opposite. It's called quantitative tightening, or QT. They start selling those assets or just let them mature, which effectively pulls money out of the economy. It's all about cooling things down and fighting those rising prices.
So, to put it really simply, QE is the accelerator, injecting cash to stimulate growth, and QT is the brake, pulling cash out to cool down an overheating economy. And for the past year or so, the Fed has had its foot firmly on that QT brake. Until now.
So why ease up now? Why take their foot off the brake? Well, it's because the Fed started seeing some really worrying signs flashing on its economic dashboard. The U.S. economy was starting to lose steam. The latest data showed that overall growth was slowing down, hiring wasn't nearly as strong as it used to be, and all that pressure from the QT brake was seriously raising the risk of a hard landing, which is just a fancy way of saying a full-blown recession.
Faced with that growing risk, the Fed decided it was time to act, to hit the brakes on their own tightening policy. Their solution is this carefully planned two-part maneuver designed to steer the economy toward a much softer landing. Part one of the plan was that small but pretty symbolic interest rate cut. Just 25 basis points, a quarter of a percentage point. It's not huge, but it makes borrowing a little cheaper and offers some immediate relief to the economy. But part two, this is arguably the much more powerful move. By completely stopping the balance sheet reduction, they've turned off the entire mechanism that was pulling money out of the system. They have essentially taken their foot off the QT brake entirely. And all of this leads to their two-part goal. First, stopping QT is meant to stabilize liquidity, basically to make sure there's enough cash flowing through the financial system. And second, by combining that with the small rate cut, they're hoping to limit the slowdown and prevent it from turning into a really severe recession. Now, a decision made in Washington, D.C. has consequences for literally everyone. The Fed's policies set the tone for the entire global financial system. So let's look at those global impacts. Okay, so when the Fed eases up, the U.S. dollar typically weakens. For emerging markets, this is like a huge sigh of relief. It gives their own currencies some much-needed breathing room. This can also encourage investors to move their money into developing economies. And it often fuels a recovery in assets like gold, stocks, and other riskier investments. So the key takeaway here, the big picture, is this. By stopping its tightening cycle, the Fed has cracked open the door for other central banks around the world to start thinking about easing their own policies. It is a major, major signal for the entire global economy. Which brings us to our final and maybe most important question. Where do we go from here? Is this the beginning of a whole new chapter for the economy? Or is it just a temporary pause?
Well, Fed Chair Jerome Powell was very clear about this. He actually said, and I quote, "A new rate cut at the December meeting is not a certainty." Basically, they're keeping their options open. They are watching all the economic data like a hawk. If inflation were to suddenly spike again, they could easily pivot right back to tightening. And that leaves all of us with the central question that's hanging over the markets. Has the Fed simply paused its fight against inflation just to avoid a recession? Or are we witnessing the very first step into a brand new era of easier money? The answer to that question is going to shape the economic landscape for years to come.